The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. The Department of Defense is working with Google to help secure America's digital defense systems, from establishing cloud-based zero-trust solutions to deploying the latest AI technology. This is a new era of American innovation. Find out more at g.co/American innovation.
Reality radio for a really great future. We're talking real money.
Give me a Q. Q. Give me an A. You're supposed to say A. What's that spell? Not a darn thing, but it is what we talk about on Fridays. Q's and A's. Your Q's, my A's. And they've been coming in, so thank you. Appreciate all of them. Really, truly do. You've been sending them in at talkingrealmoney.com by hitting the Contact Us button and then speaking them into the microphone thing on your product. And by the way, you know the microphones that sound shockingly, amazingly good? The microphones on iPhones. They sound almost broadcast quality. They're that good. They're so good. I don't know how they do it. I was listening. As a matter of fact, I made a 3D video the other day, and the iPhone also does spatial sound. Again, I don't know how it does it. It's magic. But it was like a rainstorm in 3D, and I watched it on my Apple Vision Pro, and as I turn my head, the sound moves around me, and it's very interesting. But anyway, the sound sounds good on your phone. So ask your question at talkingrealmoney.com. Now, our first call is actually a couple of calls that came in from the same person. So I'm going to edit those up a little bit because they're very long. And let's do the first half of the question, and then I'll do the second half because they're two different accounts. So here's the first half.
Hello, Don and/or Tom. Balin here from the still somewhat snowy mountains of Colorado again, though it is starting to warm up a bit. And so now why I'm calling today is I have a personal Fidelity account that I try to put a little bit in every week or so. I started off with putting a little bit into the 3 Fidelity funds that you recommended on the website, along with a couple of others that I put into a while back, which in total is about 4,000. So that includes the Fidelity Total Market Index, Total International Index, and the U.S. Bond Index. I also have a little bit in the Zero Total Market and also a couple of shares of SPY that I got back in 2020. When I heard you guys talk about AVGE, though, I was wondering if that should be something to look into as well. I'm not married to Fidelity, so but I hear about you talking about Vanguard pretty often, so I was wondering if there was a thought or preference of service or value between the two services out there, or any other service out there. I'm in my accumulation phase, and I'm not really too worried about the ups and downs of the market. I'm just looking to be nicely diversified and without the need to fiddle with it too much. I also have a few $1,000s from my closed Stash app account and was wondering if I should try Vanguard or stick with what I already have with Fidelity. This would be money to save perhaps for a future vehicle or house down payment, if not further down the line. I do have some money in a high yield savings account for a rainy day fund that I'm building up also with Wealthfront. But any advice or opinion would be appreciated with anything that I just talked about. So thank you very much. Take care.
Well, you're in that accumulation phase, so you want to be accumulating. You want to be taking risk. You're comfortable with risk. I think what you're doing is fine, although I don't see – I personally believe that longer-term AVGE is likely to outperform your equity funds at Fidelity just because of its more aggressive nature, but I don't think that any big changes are necessary. Go where you're comfortable working, and that can be Vanguard, that can be Schwab, that can be Fidelity. Heck, you can pick up a little AVGE and add it to your current portfolio even. I don't believe there's going to be that big a difference. I think what you're doing is fine. It's more about continuing to accumulate and not panic, but be as aggressive as you can comfortably be. Now to the next part of your question.
About my Fidelity retirement account this time. My workplace does provide a pseudo 5% match. I say this because the first 3% is 100% match and the remaining 2% is a 50% match, and intend to continue doing so from now on or at least for however long I remain with the company. Currently, about 50% of my retirement is in the pre-tax and 25% is in the Roth and 25% is in the safe harbor match. I'm not too familiar with the safe harbor part, so maybe if you could mention something about that, it'd be nice.
Okay, I'll break in here on that. Just the safe harbor 401ks are, they have a requirement that the employer must make a contribution, and that contribution is immediately vested, but it allows the employer to immediately also deduct that, and it's a way around some of the safe harbor rules for highly compensated employees. So now on to the rest of your question.
My main question is about the fund choices. It looks like I have up to about 32 options. I'm a fan of keeping things easy to manage. So currently my pre-tax account is in the T. Rowe Price Retire 2050 account, and my Roth is in the T. Rowe Price 2055 account. So that would be right before I turn 70 and just after I would turn 70. There is a list of large and small cap options, including ones from Vanguard, like the VMCIX and the VSMAX. So the medium cap and small cap there. And the AFMOD-GRNINC. So that's the RBAGX, which seems like a potential blended fund option as well. I was just wondering if it seemed like any of those other options might seem more useful, or if the target date funds that I currently am using might be the best overall option I have. If it seems like sending an email or something for like a full list of options that might be more useful, then I can give another call back in the future about it. Oh, and one more thing real quick. I also have an old TSP account worth about $5,000 back from my irresponsible military days, in which I seem to have put very little into it and accidentally left what little I did have in the G fund for far too long before moving it into something more aggressive. I was wondering if I should leave it alone or if maybe it would be recommended to do something else with it.
Well, while we like the G fund in the TSP, you're young, you're accumulating, as you said. It's a little bit of money. It's probably simpler just to combine everything in one location, but it's a minor thing. As for the 401k, you desperately need that complete list of all the options that are available, because you've got this mess of stuff like that AF whatever, the RBAGX. That's American Fund Moderate Growth and Income, which is an expensive fund. You've got the T. Rowe Price actively managed expensive funds at like 65 basis points, whereas you could go to Vanguard and pay a fraction of that in their funds. So I would rather see you build a well-diversified Vanguard portfolio if that's the only low-cost options and index type options that are available to you. If you had some DFA funds in there, I'd be using those. But Vanguard is my next choice. I would not have the American funds. I would not have the T. Rowe Price. Not at all. 65 basis points for a target date fund is just outrageous in my opinion. So it kind of needs a rehab, the whole thing. You're a little hodgepodgeried across the accounts, and you could probably use some planning. I really believe you could, just to come up with an overall portfolio that works between all the accounts. Thanks for the call, the question, and let's get the next one.
Hi, Tom and Don. This is Derek from Baltimore. Always love your show. My wife and I are 47, and currently we're in 100% stock. About 65% of our index fund holdings are in a regular brokerage, and 35% are in tax-advantaged accounts. So, now that we're about 12, 13 years away from retirement, we want to retire about 60. I wanted to start diversifying with bonds, maybe for now, maybe 15% of our portfolio. I was planning on buying simply Vanguard's BND, and I know it's best to hold bonds in tax-advantaged accounts rather than our brokerage. So my question is how do I begin to do this? Is there some strategy around it, or do I just go into my tax-advantaged accounts and sell some index funds fairly evenly across asset classes and start buying BND? Is it that simple, or should I be putting some more strategy around this? Thank you, guys.
There's really no strategy you could employ. There's nothing special. I mean, you would do this later as part of regular rebalancing, but here's the number one way to do it where you don't have to sell anything, and that is to just move all future contributions into bonds for a while until you get to the percentage that you want for your portfolio. So that's the best way to do it. The second best way is just across the board, sell a little from column A, B, C, D, however many columns you have, and move all that money into BND. That's what I would probably do unless I was making large contributions that would get me to that 10 or 15% a little more quickly. There's no hurry to get there because you're still well over a decade out from even thinking about using the money. So don't rush. And I think you could do it through future contributions. Thanks for the question. Let's do another.
Hello, Don. My name is Jay from the Colony, Texas. I listen to 9 or 10 financial podcasts, and talking real money with you and Tom is always in the pole position. Then I let Spotify choose what's next. My question is, when an average return is quoted for an ETF or mutual fund, is this a strict mathematical calculation, or is it based on a hypothetical amount? And I will give you an example. I've asked the same question to 2 different advisors, and all I've gotten were smart aleck answers. Hoping you will provide a real answer. The example I have has no dividends or interest. Let's say over 3 years, an ETF has annual returns of plus 30%, minus 30%, and plus 9%. Mathematically, that's a plus 30, minus 30, plus 9. Divide that by the 3 years for an average of 3% a year. However, if I'd put $10,000 in at the beginning of year 1, at the end of year 3, I actually have $81 less than when I started. I saw a negative return, not the 3% mathematical answer. You and other podcasts frequently mention averages, just wondering how these are calculated and determined. Keep up the great work, and I will continue to listen. Thank you.
Thanks for the nice comments there at the beginning. And I don't understand why advisors would be snarky about this, give you smart aleck answer. Although, if Tom was here, you'd probably get a smart aleck answer, just because you said that earlier. It's mathematical. It's really, really simple. They're not using a dollar amount. They are merely doing what you said. 1 year 30, next year negative 30. Average annual return for those 2 years is going to be 0. Add in 9 the next year. Average annual return for the 3 years is going to be 3. That's it. That's how they figure it. It would be too hard to do it any other way. So they're not showing you actual returns. It's just but they do the calculation with a mutual fund. They do it on a daily basis. So it's constantly being refigured. But yeah, it's math. Thanks for I don't know how you get snarky about that. Thanks for the question. Let's grab another one.
Hello, gentlemen. My name is Casey. I'm from Albuquerque, New Mexico. I'm a government worker in the TSP FERS program, and I kind of got a late start contributing to my TSP. I think I was 39, something like that, when I started contributing. Long story short, I have about 9 to 10 years left of to contribute, and my balance is a little over 100,000. Market's been down. I'm doing 70% in the C fund, 10% S fund, and 20% I fund. I have about 114,000 in there now, and I want to get up to 500,000 in the next, hopefully, by the time I'm eligible to retire, which would be between 57 and 59. So any insight or tips you could give me would be very helpful. Thank you.
Well, the trick is going to be increasing your contributions more than likely, because you're not, I don't know what you're contributing, but you're not likely to make it without averaging about 12 to 1,500 a month in contributions over that decade. And that's assuming a 7 to 9% average annual return over that period, or annualized return over that period. It's going to require a couple of bucks put away, and your portfolio, I think you should have more in international than you have, but it's not bad. But I think that probably 1,300 to 14 is really the sweet spot, given the level of risk you're taking in your portfolio. Again, future unknown completely. We have no clue. Thanks for your question. Let's go to the last one.
Hi, Don. I recently opened up a Fidelity Roth IRA, and it's in addition to my work-sponsored retirement plan. And I'm trying to figure out a 1 or 2 fund solution to fund that. And I'm down to 3 options: the AVGE, DFAW, or VT with a AVUV 10% tilt. Looking to have you sell me on why DFAW or AVGE would be a better solution than the VT with AVUV tilt. Considering that the fees of VT are considerably lower than the other 2 funds. Look forward to your thoughts. Thank you.
Well, I'm not going to try and sell you on anything, because I think they're all fine options. I really do. The difference is the level of risk being taken, and that's always what it boils down to. Yeah, the fees are lower a little bit. When we're down to 25 basis points, we're in that such low end that it doesn't make a ton of difference, but it does make a difference. So VT and AVUV are going to have a bit of an advantage over AVGE or DFAW, which are the Avantis Total Global Market Funds. Avantis and DFA, Total World Fund. The thing about the AVGE and the DFAW is their higher level of risk-taking. When you go with more small and more value, then you increase risk, and you can see it. You can see it in the recent performance. Both of these are relatively new, but you can see in markets where the global market has done well, DFAW and AVGE have done a little bit better than the market. In the recent period where the market has done poorly, the AVGE and the DFAW have posted bigger losses than the VT would have posted during that same period. So it's a level of aggressiveness, and they're all excellent options if you want to have a ride that isn't likely to be as frightening. Then the VT AVUV combo makes sense. But if you want just a one fund to accomplish that whole thing, then either DFAW or AVGE, they're so close to each other in terms of styles that I don't know who I'd bet on long term, because that's kind of what we're doing, picking which one we think will do better when they both have a very similar approach to how they asset allocate. Thank you all for being a part of the Q&A podcast. If you have some questions and you'd like to actually discuss them with us, every Saturday, Tom and I do a live radio show in Seattle that becomes a podcast the next week, and you can call us starting at 3 p.m. Eastern Time at 855 855-935-TALK, 855-935-8255. The calling sweet spot is between about 3:15 Eastern and 4:45 Eastern, that hour and a half period, because we don't want to get too close to the end of the show and we do something at the beginning. So if you're listening to the podcast, well, you can call us and actually have a conversation, or you can send your questions in at talkingrealmoney.com. Just click the button that says contact us and speak it in, or type it, I guess. Thank you very much for being a part of the program. I hope we've helped you a little bit with these answers. And if not, well, make sure you ask. And if you ask, we'll answer. Well, as long as we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.